I think just momentum could take us down another 5 to 10%. So I think we're looking at a bottom in the market that's below this. So I do think that there's more downside to come, but getting down 20% from here would take us well below 3,000 on the S&P, and that feels like a big overshoot.
We got 20 seconds. What would you do then?
SoFi was yet again on the brink of reaching its 52-week low of $4.79 per share. But SoFi is not the only one taking a free fall during this bear market. Upstart, Affirm, and PayPal are also joining the Guinness Book of Records on the world's most beaten down fintech stocks for 2022. PayPal is down 69% from its all-time high of $273.51 a share. Affirm is down by 89% from $176.65 a share. Upstart ranks first in the fintech mess by having a 95% decrease from its all-time high of $401.49 a share. Even the legacy banks aren't looking too hot right now. JPMorgan Chase, Bank of America, and Citigroup, who also had a reverse split stock in the past, are roughly 30 to 40% down from their 52-week highs on record. With fear, uncertainty, and doubt being spread like wildfires, 52-week highs may or may not be the best measure to keep track of how good a company is and where it will likely be going in the long run. From the looks of it, inflation isn't going away anytime soon. In any way you look at it, SoFi is an undervalued company that delivers results. The stock price isn't looking good, and short-term investors are freaking out. With retail investors owning most of SoFi and institutional investors backing down, is SoFi in a position for a buyout? In this video, we'll discuss a little about whether or not SoFi is in position for a potential buyout and why retail investors own most of SoFi today. Be sure to stick around until the end of this video to see what SoFi's Liz Young has to say about investing in today's market. By the way, if you haven't already guessed, we are not financial advisors, and this is not financial advice, so always do your own due diligence. We're still in a bear market, and even the experts like SoFi's Liz Young haven't confirmed we've reached rock bottom. But there's been tons of negative factors dragging SoFi down. Is SoFi a takeover target? According to the Motley Fool, here are 3 signs you'd want to take a look out for when a company is about to be acquired. Number 1, dominance over a key market segment that the larger rivals cannot easily replicate. Fintechs like SoFi are reshaping the banking system while simultaneously being the biggest competitors for legacy banks. The big banks have sustained market share and a competitive advantage over the fintech players in the market. Fintechs are mostly customer-centered and are more focused on innovation, and they make the best out of technology to make the best offering suited for each one of their customers. This isn't something that's easy to replicate for the legacy banks. SoFi sure does dominate the market segments and enjoys a one-stop shop strategy, and that's something that the big banks cannot easily imitate. However, it's SoFi who's acquiring and not the one being acquired. Remember when SoFi spent a fortune in getting Galileo and Technisys? It's only a matter of time before this tech duo takes effect in full swing for SoFi's operation, and once that happens, it will be a huge tailwind for SoFi. Number 2, worsening operating trends. SoFi started nearly 11 years ago just doing student loans. Rome wasn't built in a day, and Amazon didn't become the everything store overnight. In fact, it didn't even gain its first positive profit for the first 9 years. SoFi started small, as other growth companies do, with a negative adjusted EBITDA of $149 million in 2019. SoFi is breaking its own records, beating estimates, and doing everything it can to get ahead with this current economy. Number 3, management is exploring financial options. Capital is the lifeline of any business, and sometimes companies need desperate measures to save themselves from massive losses and inconsistent performances. According to Motley Fool, when a company says it's exploring financial options, it's most likely that they're on the hunt for potential buyers. But for SoFi, let's hear a note from Commander Noto.
Now I'd like to spend some time touching on the segment level results. These highlight the benefits of our uniquely diversified model, the robust growth across all 3 business segments, increased efficiency driving improved profitability, and our strong balance sheet with multiple funding sources. All of this with strong and stable credit metrics.
SoFi is growing in a lot of ways, and one way you can see is in its results. SoFi's lending segment is killing the game, originating nearly $2.5 billion in personal loans, up by 22% from Q1, even with the student loan payments on hold. SoFi's financial services segment also gets a boost from the perks of SoFi Bank, like offering industry-leading APY to SoFi Money members. In Q2, SoFi's financial services products have reached 100% growth from last year, and if you didn't know, banks generally get their money for operations from their depositors. With all that growth, we don't think SoFi is in deep trouble with their finances, as they have been managing to give us satisfying results every single quarter. SoFi's stock price may have been a little bit down for some time now, but the operational results tell us that SoFi has huge things coming up in the years. Tell us that SoFi has a bright future ahead of it. At the time of recording this, the majority of SoFi, nearly 50%, is now owned by retail investors like us, while institutions owned around 35% of it, and 10.2% is owned by insiders, according to the Nasdaq's data. Institutions are backing down, and now I know what you're thinking. When many institutions buy a stock, it's usually a sign that it's a good company, and when they're selling, it's most likely a bearish sign. Apparently, it's not only SoFi who's suffering from institutions selling their stocks though. Institutions have backed down and started setting records on stock sell-offs this 2022 from multiple sectors involving finance, energy, healthcare, real estate, and more. According to sources, only the retail investors are left holding the bag and have become the biggest buyers of the remaining stocks today. This move is likely logical because institutional investors are responsible for huge amounts of money, which likely explains their lack of appetite for risk when compared to retail investors. You know what they say, the higher the risk, the higher the reward, and maybe institutions just aren't up for the game, especially when the inflation scare is just right around the corner. On the flip side, we're about to see how much SoFi has grown over Q3, as we'll be having the Q3 2022 results conference call on November 1st. At this point, we don't think SoFi is positioning itself for a buyout, as we see lots of results speaking for themselves. Like Kathy Wood says, innovation is on sale. And whether or not you're buying SoFi, make sure you choose what's worth your money.
Right now, if you're worried about currency contagion, I think it's okay to own gold. I think it's okay to own treasuries. In the stock market, buy the stuff that's still reasonably priced. That's financials, healthcare. I think you can start dripping into industrials. And then later in the year, you really put some of the risk back on.
Shout out to everyone who commented on our previous videos, and a special shout out to everyone in our Patreon community who continues to support this channel. We truly do appreciate the support. Shouts out to Arthur Magazu, Daniel Corbett, Mr. Welfare, Casey Patel, Jeff Sherman, Gregory Villar, Denzel, Reginald Davis, Les Broadway, Christian Cardelphi, Kevin Bovron, Jay Bone, and the man Alan. Really appreciate all the support, and thanks for watching. Until next time, peace.